This only happens about once every 10 years, and most investors, they're not even prepared to take advantage of it. Stay tuned, I'm going to show you why. You need to get in now, because what are the key points? What's coming on Monday? There's a lot of things happening this week. Here's what you need to know. We've got rate cuts coming up. Now, will the Fed cut 25 or 50 basis points? We don't know. Now, I think they're going to go 25 and then keep every meeting live after that. Some people are saying 50 basis points and then a pause. But here's the opportunity. It's going to be in the rates market. I'm going to show you what that is. But Goldman's saying right now, hey, if you think rate cuts are bullish, watch out, because there's another thing that starts on Monday, and this is something everybody needs to know about. It's the corporate share buyback blackout window. It's starting again on Monday. And then we've got market breadth. I've been warning about this for weeks. I'm going to give you an update on it, because when you put all these pieces together, well, then you can see why. There's going to be some big opportunities here. But the problem is there's some cliffs coming for the market, and some massive ones. Let's talk about what Goldman is warning about, because they're saying, look, wait a minute, it's maybe not as bullish as you think, because the Fed is going to be cutting not based on inflation, but the labor market. Now, this stage in the game, this only happens about once every 10 years or so. The Fed starts an aggressive cutting cycle. Now, the risk for equity investors, which is where everybody's focus is right now, is you've got about a 3-month window from the first cut before the market starts to figure out that the Fed's cutting for all the wrong reasons. Now, we know that, but the problem is the market's focused on the wrong opportunity. They should be looking at the bond market. Now, let's talk about corporate share buybacks. And on top of all this, I've got something else for you. I've got some amazing trades set up right off of our new optimized meta strategy. Stay tuned for those, because on Monday, the corporate share buyback blackout window starts to go in effect. Now, it's small at first, and this is going to ramp up. But on Monday, we start to see the first companies go into blackout. Now, there's a big risk, and something during earnings I want you to be focused on, because a lot of companies are buying their stock back. Now, what we're going to see in the labor market is they're going to start laying people off. They're going to use the excuse of the economy or tariffs or margin compression. The real issue here is if they cut back on their share purchases, well, watch out, because right now they are the biggest buyer in the market. Because Goldman notes the median buyback aristocrat has reduced its share count by an annual average of 4% over the past decade. Now compare this to the median S&P 500 stock. There's been no change in share count. So as they buy back their stock, they're issuing in a massive amount of stock. So if they pull back, if that number starts to drop, watch out. The biggest buyer in stocks is pulling back, and that means support is going to wane. Now, something that could go with that, and we're not worried about this today, but let's talk about machine positioning, because at some point this is going to flip. Now, I want you to see these two slides here, because we've got the global equity position, the systematic macro, and it's not at extreme levels, but it's at a very high level. Again, there's not much buying here, which what we could see in this chart here to the right, it shows there could be a little bit of buying, but any major move down in the market, they are going to cut and run. So again, we talk about the risk here. Rate cuts, bullish for stocks, but only over the next couple of months at best. Very bullish for the bond market. But again, many people are not positioned for this. Let's take a look at Bank of America, because they noted in their private client accounts, there's a 64.2% allocation to stocks. This is the highest since March of 2022. So now you start to see the risk coming into perspective. Rate cuts on job cuts, not bullish. You've got corporate share buybacks. Well, if they're going out in their blackout window, that's not the major issue. If there's cutbacks in how many shares are buying, that's the risk. But look at this. Look at what's coming, because the bond market, what do they see? Their clients, 18.1% their exposure to bonds. That is now the lowest since May of 2022. So you can see the opportunity here, because Fed rate cut cycles, well, they only come around about once every 10 years. And you can better believe the entire bond market is going to follow what the Fed does. Now, something I've been warning about for ages here is breadth, and it's not getting any better, because again, hold your breath, but not for long, because what it's signaling to us is the equity markets. While they're still rallying, that is not going to last forever. Let's take a look at the percentage of S&P 500 stocks trading above their 50-day moving average, just under 62%. Now again, you're not going to see this in a price chart, and the risk is where breath goes, price follows. So again, it's bullish when a stock is above its 50-day moving average. It's bearish when it's below. As more components of the S&P 500 fall below that, well, what happens is the leaders are going to follow right alongside with it. But let's take a look at our screens here. We're going to look at, of course, all the sectors of the market, and I've got some great opportunities for you. I want you to see them. But first, let's take a look at the S&P 500, because some of you are saying, but Steve, the price is going up. And you're right, it is going up. The problem is breadth is weakening. And again, this is what investors can't see in a price chart, because they're saying, look, it just looks really good. But what you don't notice is one by one, companies are falling below. That's this green line here. That's the 50-day moving average. And again, my friends, that is a bearish indicator. Where breath goes, price eventually follows. Now, let's touch on our meta strategy, because I got some trades coming for you in today's show. We fully optimize this. Now, what does that mean? This strategy looks at 9 separate strategies and combines them all together, and it's optimized for swing trading, but we took it to another level. We optimize it on a per security basis for every strategy, combined them together with a target hold period of 10 days. And this thing blows everything out of the water. I'm going to show you some real world trades based on this. But again, if you want to get in and start getting these trades, all you have to do is grab those links in the description below, sign up for either one of my reports, and use that coupon code for your free 30-day trial. And you're going to be blown away at these trades over the next 30 days. Because breadth isn't just an issue for the S&P. Look at this for tech stocks. Now, this is interesting because these tech companies, they buy massive amounts of their stock back. But look what's happening. Only a few are standing. It's going to pull the rest of them down. But again, you don't see this on a price chart, because let's go back and look what happens. See, breadth leads price. In this case, breadth is again leading to the downside. Only 47% of the NASDAQ 100 is sitting above its 50-day moving average. And again, it's a major red flag for price. Again, we've got positive momentum here. We've got machine positioning that's stretched. Now, we model machine positioning. We look at momentum signals. So whether you want to trade against the machines or trade momentum signals, grab either report, because with both of them right now, you get those optimized meta strategy trades. Again, it's going to change the way you trade. But again, the issue with the QQQ, well, again, you don't see weakening breadth. You just see higher price, but that is going to change and here in the near-term future. But let's talk about something we were bullish on. That is the Russell 2000. Look, price was going up and breadth was falling, and then all of a sudden breadth turned and it started to go the other direction. Now just over 66% of the Russell 2000 trading above its 50-day moving average. But what do we see here? Again, 15 consecutive daily buy signals. Machine positioning stretched to the long side. Momentum also stretched. Everybody is all in U.S. stocks. The problem is when you look at a price chart, you start to see some weakness, and it's not showing up just yet. We see it in breadth. Again, that's the issue, because look back over a 2-year chart. What did I say? This is likely going to race up and form a double top, and that would be a very bearish signal. Right now, we're on track to see that happening. But let's talk about some opportunities in this market. Because you know what? When you're making money trading, you got to celebrate. How about this? DB Agriculture. This is symbol DBA. Now, you might remember not long ago, we made a bunch of money trading this. And then what happened last week? MetaStrategy said, look, hey, we made some money, and it's time to make some money again. So I'm going to show you some real numbers here. This is right what goes out to my subscribers can get to you as well. All you got to do is sign up, because back on the 12th, we told all our subscribers, put a buy it open on this. This is the live stop loss level. Again, we give our subscribers risk control levels. A lot of people don't do that. Right now, that trade is up 0.36%, and you can get in on it. It's not too late. Now, let's take a look at a price chart of this, because I want you to see why the strategy picked this up. And it's very clear, because it pulled back right into its 21-day moving average, and it's pulled up from there. Again, we were put a buy back on Friday, and that trade again is up, looking to race back up here, potentially another double top. But one of the differences, one of the advantages that our subscribers have is we update our risk control levels right along the way. Now, something that may be bullish, could be bearish as well, is the energy sector. And right now, there are people on both sides of that. Some people are very bullish because they're saying, wait a minute, these energy companies are laying a lot of people off. It's because they're defending their corporate share purchasing plan. They're defending their stock. They got to lay people off. The other side of the story says, look, macro fundamentals are weakening. Let's take a look at XLE. What do we see? 15 consecutive daily buy signals on our Momentum Timer Pro. You'll note we don't have a position on this right now, even though machine positioning is picking back up. Let's take a look at a chart of XLE here. And I've got some trades coming for you. Hang tight. All right, let's take a look at that price chart. What do we see? A possible breakout here. Now you see it ran up, created a flag here, then it broke out, got sold down right into its 50-day moving average. And again, that's a bearish sign, because when you have a positive cross of a moving average and it confirms it, well, that is bullish. Now it didn't confirm it here, but it rallied back. It held the 200-day. If it breaks above this price right here around 90.56 or so, watch out. You could see a run potentially up into the 95 range here. I think there's some bullish narrative here, but a lot of market participants are saying not a chance. But let's talk about financials, because banks are sitting at all-time highs right now. And a lot of people are going to say, wait, rate cuts, that's going to be bullish for the banks. Except it's actually not bullish for the banks, because remember, they make money on something called net interest margin, and that's going to decrease. Now, the risk for banks here is you're going to see rising delinquencies that lead to defaults. If rate cuts don't lead to a huge surge in lending, well, watch out below. Now, in the short run, likely to see a rally, but don't expect that to last. But let's talk about that Fed trade, because it's all about the bond market. Again, this is right off our Metre strategy. This is an optimized trade that just came out for Monday. And what we're saying is, look, here's your buy at open on the 15th. Here's the live stop loss. All this went out to all our subscribers. Now look at the machine positioning. On our fast algorithm, it's already long. On our slow algorithm, that tells us it's almost at full capacity here, meaning machines have been buying. Momentum for the last 30 days have been supporting price here, and now we're seeing potential breakout move on the fact that the Fed is likely to signal that there's going to be further cuts. Let's take a look, because this thing has gapped up and run, but there's a little bit of a consolidation right in here, setting up a potential move right up here and here to the low 99 price level. Again, all of this is about the Fed. And what's interesting here is, again, most investors are not positioned to take advantage of this. They're so focused on the equity market that they can't see that a rate cut at this stage isn't bullish for long. But the real bullish narrative is in the bond market. But let's take another look at a trade that we crushed. And you could have gotten in on this for free. This is what's crazy, and that is junior gold miners. This right now is up 9.95%. We put this trade on the 2nd. Here's a live stop loss level. Again, along the way, we raised our stop loss levels because, again, what our subscribers make money, the key thing is we want to keep it. And when things go the wrong direction, we want to control our risk. And again, we're changing the way people trade with our new optimized strategy. Again, you got to get in on this. So easy to do. All you have to do is grab those links in the description below. Let's take a look at the dollar, because right now, so many people are bearish on the dollar. In fact, I read a Bank of America report this morning and said, look, the easiest trade right now is short the dollar, sell the dollar, dump the dollar. It is the narrative for the rest of the year, is don't own the dollar. But wait till you see this price chart. And after that, I got one more trade for you right off of our Monday report. Let's take a look at this, because the bullish narrative for the dollar, well, it's not in momentum. You have 13 consecutive daily sell signals. How about machine positioning? Well, you're 35% long on our fast and our slow algorithm. There's nothing here that you'd get excited about. The RSI is at 49. The MACD's got a negative cross. But wait until you see the chart for UUP. It kind of changes your perspective a little bit. Well, at least it changes mine. Because look at this. This is a 2-year chart. You see that red bar right here? That's the 2-year volume profile. That means the most shares over the last 2 years have been traded there. Now let's zoom into the 1-year chart. guess what? Hasn't moved. Let's go to the 6-month chart. No surprise, hasn't moved, and guess what? It pulled up right alongside its 50-day moving average. See that blue line? That's a 100-day, and it's all intersecting right here. You're getting a bullish cross on the moving averages with support at a 6-month volume profile. So right now, while the consensus is, hey, you want to be short the dollar and in a major way, perhaps the market is setting up that perhaps the rate cuts are indeed bullish for the dollar, which they typically are, because again, when the Fed cuts into a weakening economy, people run to the dollar for safety. But let's talk about that other trade that's going out for a Monday for our subscribers, and that's on corn. Now I want you to see this chart because right now it is crazy, but again, we give our subscribers risk control levels. This is the live stop loss level. Now let's look at machine position because they've been buying here. You can look at momentum. It's coming off of a weaker level, but momentum is positive. The RSI is a great level. It's at 63 and rising. MACD's got a positive cross. Everything you need to see in the setup, but let's take a look at that price chart here, because this is what's very interesting is you've got a head and shoulders bottom potential here. You got a left shoulder ahead, maybe a little right shoulder here, consolidating below that supply zone. And right now, price is breaking out. Now you see these purple lines, these are called supply zones. Now the bottom one here, this is where people were selling. They're getting squeezed. So right now, that means the next supply zone where you see sellers is right here where that 200-day moving average is. That's that line running across your screen, setting up a bullish move potentially on the squeeze of the shorts all the way up to somewhere around $18.45. That's right around the 200-day moving average. So again, let's kind of recap the show here, because next week we've got rate cuts coming on Wednesday, Powell signaling going forward. That'll be very constructive for the bond market. We got corporate share buyback blackout window starting on Monday, but again, it's all about what corporates are going to do. If they're going to pull back on their purchases, again, that's a red flag. And then you've got breadth. It's weakening. But no matter what the market is doing, there's always opportunities. That's what I wanted to show you today. Our optimized meta strategy is changing the game, finding fantastic opportunities for you to make money in the market. All you got to do is grab those links in the description below. Use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.